Attention, folks. Welcome to another chaotic yet brutally honest episode of Boss Economics World. Today, we'll dive deep into one of the hottest topics on everyone's mind, the tumultuous U.S. Treasury market, the Federal Reserve's indecisiveness, and the looming employment data that could throw us all into a whirlwind of hypervolatility. But of course, as we always say here, when the problem looks like a small crack on the surface, you can bet your bottom dollar that the cracks underneath are bringing us to the edge of another economic catastrophe. Strap in, because we're not holding back today. Let's start with the first layer of the problem. The U.S. Treasury market is tumbling like a poorly built house in the middle of a hurricane. The month of October brought the worst bond performance in 2 years. Now I know what you're thinking, but hey, didn't the Fed keep promising rate cuts? Well, yes, they did. But let's dig deeper, my friends. Bond yields have been rising, with the 10-year Treasury yield pushing toward 4.5%, a significant leap from around 4.3% just a few weeks ago. This is despite all the assurances from the Federal Reserve that they'd continue trimming down rates. Who's to blame for this? Well, I'll give you a spoiler, it's not just the natural market cycle, and it's definitely not just about some bad weather or labor strikes interrupting productivity. There's something fundamentally broken in the way the U.S. economic policy is managed, and simply lowering rate expectations won't save us. We're going to rip off the Band-Aid today and ask the tough questions that won't let policymakers off the hook. But first, we have to explore how the Treasury market chaos reflects some serious incompetence in handling key financial issues. The market is on high alert, bracing for the hurricane-tinged U.S. employment report. What a sight to behold. Like good little sheep, traders are clinging to the hope that this report will offer clarity leading into the Federal Reserve's big policy decision next week. But here's the kicker, the investors want to shrug off any weak numbers in the jobs report, blaming the hurricanes or those pesky labor strikes. Basically, whenever it's convenient, external factors suddenly become everyone's favorite scapegoat. Oh no, it wasn't us. It was the weather, folks, the weather. But strong job data could remove this temporary smokescreen, forcing the Fed into a very awkward position. Right now, labor market strength would only confirm that inflation is still too hot, and they're trying to curb it with baby steps, quarter-point rate cuts, sending mixed signals as though that will calm the storm of volatility. But is that enough to turn the tide long-term? Spoiler, it sure isn't. Many analysts are already acknowledging what we know at heart, the Fed likes to keep the markets on edge but doesn't like to seriously disrupt them. Jack McIntyre from Brandywine Global Investment mentioned how the Fed hates surprising the market. What happened to the radical policy swings to save the system, huh? Welcome to the era of trying to save face while the house is clearly on fire. It's no accident that bond market volatility peaked at the same time as political tensions hit a fever pitch. Traders and investors across the financial sphere aren't just fearing volatility in the bond market because they're unsure of the next interest rate cut. Oh no, this is about something much broader, political uncertainty, with Trump and Kamala Harris as opposing forces, could shake the entire financial infrastructure in the weeks ahead. Now, I want to make this very clear. Political sway isn't just background noise to economic conditions, it's the puppet master pulling the strings. The ICE B of A Move Index, which measures bond market volatility, hit its highest levels this year, showing that investors are desperately seeking ways to shield their portfolios from the inevitable storm. A premium of $10 million was paid just to hedge some bets via options tied to the Secured Overnight Financing Rate, SOFR. What does that tell us? People are nervous, and they have every right to be. We're not just watching some badly managed political theater here, we're talking about months, if not years, of financial data being wiped out in the crucible of political showdown and policy gridlock. The November 5th election showdown, coupled with the potential for the Federal Reserve to keep flip-flopping, has the whole market on edge. As investors nervously await Friday's jobs report, the tension is palpable. Because here's the deal, whatever happens in the labor market, it signals more than just employment statistics, it will either arm or disarm the powers steering these massive economic decisions. Okay, deep breath time, let's address the elephant in the room. The US Treasury sell-off over the last month. Oh dear, that's about more than just investors pivoting away from fixed income assets. It's a direct symptom of a much deeper, much darker reality: rising government debt levels, unsustainable fiscal policy for years, and a reluctance to bite the bullet. Yields have jumped roughly 60 basis points in October alone. Some people are panicking, thinking this is an overreaction. But in reality, this could just be the start. When your economic policies are about as cohesive as a patchwork quilt made by a toddler with scissors, what happens? Well, surprise. Investors start wondering if your entire bond market is just a house of cards waiting to collapse. As we watch this panic spill into the world of options trading, with bets of $6.5 million on a 4.4% 10-year yield, and expectations the yield could rise to 4.5% soon, folks, this is investors literally gambling on which part of the Titanic is going to sink first. The sinking isn't over yet. So now comes the kicker: traders right now are pricing in about a 90% chance of the Fed proceeding with a quarter-point rate cut in the next few days. Okay, a mini cut, if you will, less drastic than the half-point decrease from September. But at the same time, market expectations for total easing over the next year fell by about 67 basis points compared to just a month earlier. What does this tell us? Investors are quietly backing off from their earlier, rosier expectations for quick rescue rate cuts. The landscape is shifting, but rate cuts are no magic wand. For all the praise heaped on our financial overlords, central bankers, a cut from 25 basis points here and 25 there won't change the elephantine problem we've been sweeping under the rug for years: structural stagnation. Let's not kid ourselves, another quarter-point rate cut is hardly going to steady this ship long-term. Policymakers still face what I like to call death by 1,000 bad fiscal policies, and each rate cut is just a band-aid on this gaping economic wound. Unwinding too slowly could lead to even greater inefficiencies in guiding growth and inflation, further punishing both current workers and future generations. If Friday's jobs report shows continued labor market strength, it gets even trickier, for the federal unemployment is forecasted to hang steady at around 4.1%, and if the figures don't change much, it signals the economy's resilience. But resilience, as we all know, can be a double-edged sword. Why? Because if job data is too strong, it reinforces the argument to hold back on aggressive rate cutting early next year. As Greg Wilensky from Janus Henderson Investors pointed out, these numbers could still shift market expectations, forcing a rethink on rate path cuts slated for future meetings. The Fed has to tread carefully here: cut rates too early, and inflation may come roaring back. Cut too late, and watch out for a recession. So where does all this leave us? In a pretty dicey situation. We've got a US bond market spinning out, persistent volatility as traders scramble to protect their investments, political uncertainty tied to both the election and the Fed, and a labor market that refuses to give the clean signals everyone is hoping for. While policymakers are trimming rates to temper inflation, hedge any potential downturns, and simultaneously trying to balance the political environment, they're tightening a knot that's already fraying at the seams. With all eyes on Friday's storm and strike-riddled employment report, the implications go deep. Expect more uncertainty from the Fed, further market volatility, and possibly a series of fixes that keep both traders and policymakers on their back foot for months to come. Welcome to the circus, people. The Fed keeps juggling, the market holds its breath, but eventually, something's going to fall. Stay sharp and vigilant, folks, because while the experts play nice with their talks of soft landings and manageable risk, we're already mid-crash, and too few people realize it yet.